you've filled up your rig in the last few days, you've definitely felt it. I mean, you've really felt it. That sudden, painful surge in fuel costs has hit the industry hard, and it's probably scrambling your whole budget for the year. So let's dive in and unpack what just happened. Here it is, the number that says it all. As of today, March 7th, 2026, the national average for a gallon of diesel is $4.51. Now that data is straight from AAA, and let's be honest, that's a number that was pretty much unthinkable just a couple of weeks ago. And that's the real kicker here. This massive price spike isn't just bad news, it is the exact opposite of what the entire industry was planning for and expecting in 2026. All the forecasts, they were pointing in a completely different direction. To really get a handle on the shock of this, we've got to rewind to the beginning of the year. Let's take a look at what the plan was supposed to be. This was the dominant forecast, the one everyone was banking on. The U.S. Energy Information Administration, the EIA, they predicted a significant price drop, an average of $3.50 a gallon. I mean, that would have meant some much-needed breathing room for operating margins. It was a forecast built on the idea of a balanced, predictable market. So take a look at this. What's so wild about this chart is just how calm and orderly it looks. This is the EIA's official chart from just last month. You see those lines for 2026? They're nearly flat. That's the stability the experts were predicting. Rising inventories, lower crude prices, a calm, predictable year for your fuel costs. And then, just like that whole story of stability was completely shattered. A dramatic geopolitical flashpoint sent the entire market spinning into chaos. And just look how fast this all went down. On February 28th, you have the joint airstrikes. Almost immediately after, retaliation from Iran. And then in early March, the big one, the shutdown of the Strait of Hormuz. We're talking a matter of days before one of the world's most critical energy choke points was slammed shut. And this is the result. This table really shows that calm forecast versus the brutal reality on the ground. A week ago, diesel was sitting at about $3.75. By yesterday, it jumped to $4.33. And today, it's over $4.50. That's a 75-cent jump in just 1 week. Unbelievable. So how in the world does a regional conflict, thousands of miles away, cause such a huge and immediate impact at your local fuel pump? Let's break down exactly why this one little spot on the map matters so much. Well, this is the Strait of Hormuz. According to Wood Mackenzie, a full 15% of all global oil demand, and get this, 20% of the world's liquefied natural gas supply passes right through this single narrow waterway. So when you shut that down, the entire global energy supply chain feels it, and they feel it instantly. And the experts, they are not mincing words here. Jim Burkhart over at S&P Global says this could potentially be the largest oil supply disruption in history. I mean, that's the level of severity we're talking about. It's a huge deal. Now here's a really crucial point. Not all crude oil is created equal. The crude that comes out of the Middle East is what they call distillate rich. Basically, that means it yields more diesel fuel when it's refined. So, when that specific supply gets cut off, diesel markets get hit even harder than gasoline markets. Okay, so let's bring it all home. Let's connect these giant global headlines directly to what they actually mean for your business, your rig, and your bottom line. As every single one of you knows, fuel is a massive part of your operating costs. This chart from Date Freight and Analytics shows it pretty clearly. Fuel usually accounts for about 32% of all your expenses. When that huge piece of the pie suddenly gets bigger, it puts a massive squeeze on everything else. And this slide right here, this explains the core financial problem for every carrier out there right now. Pump prices, they surge instantly. You pay that higher cost today. But the fuel surcharges you pass on to customers, well, they typically only adjust weekly. That lag, that gap, creates a brutal cash flow pinch where you're fronting the higher cost completely out of pocket. So finally, what's next? Where do we go from here? Let's see what the experts are forecasting for the near future and what, if anything, is being done to manage this whole crisis. Well, the short-term outlook is for more volatility. No surprise there. Analysts see diesel prices staying high, maybe even pushing a bit higher. Crude oil could easily break that critical $100 a barrel mark. And as analyst Tom Kloza puts it, it's hard to tell if we are in the second inning or the middle of the game. We just don't know where we are in this thing. Now, there has been an initial response from the government. The White House has ordered financial guarantees to try and get maritime trade moving again, and they've even said the U.S. Navy could start escorting tankers if it comes to that. It's all an effort to restore the flow of oil. So, this really sums it all up, doesn't it? On the left, there's the plan, that calm, stable forecast we all started the year with. And on the right, well, that's the reality. A volatile, uncertain market where triple-digit oil prices are a very real possibility. And all of this leaves us with a huge question, a really critical one for the entire industry. In a world where one event can upend global markets in just a matter of days, is the whole idea of a stable, predictable fuel price, is that just a thing of the past?
That's all the time we have for this explainer. I want to thank the entire Bakar Express community for tuning in. We know these are really challenging times out there, and staying informed is more critical than ever.
Please be sure to subscribe for more updates just like this one, and share this analysis with others in the trucking community who really need this information. Stay safe out there.